The best Neos ETF funds for 2026. Who has the highest total return and yields? Well, we're going to break down each and every one of them, give you a highlight. Who is the monthly income king from Neos? Hey everybody, it's Doug, the retirement guy, with all your monthly ETFs. And today we're breaking down one of the most popular brands, one of the most popular issuers out there, and that is Neos. Now, I know a lot of people, including myself, have a lot of these funds in their retirement portfolios, and we just, we never really take a serious hard look at them to see, do we have the right pieces in the right spot while we're going through retirement. So let's break it all down of who's number one, who's doing the best in 2026, and who's not. So let's get into today's video. Performances do not guarantee future results, and the information provided in this video is for educational and informational purposes only. It should not be considered financial or investment advice. Examples and suggestions discussed are illustrative and may not be suitable for all individuals. I am not a financial advisor, so if you need one, get a licensed financial advisor and a professional to help you in financial decisions. So why do I focus on total return? It's because it shows the real big picture. Total return will tell you what your income plus or minus your growth is. So you see a lot of ETFs out there that have huge 40, 50% distributions. And you think, oh my God, that's amazing. I can retire off of just one item. But you got to add in that growth side of it to get the total return, because many of those funds are paying 40, 50%, are actually losing 10, 20, 30, sometimes 50% in growth. So it's only your own money coming back to you. So the total return captures it all, including the price appreciation, which is our growth, and the income, which is your dividends. It makes for better decisions. It avoids the misleading signals. And it measures wealth creations, because one of the things I always want to tell everybody is, remember this, the goal here is to grow your money, not just collect a paycheck. Okay? Yes, you're going to get a paycheck on a regular basis from distributions, but man, if you're not growing your portfolio, then you're really just taking your money out and spending it. So I always say, don't get caught in your yield trap, because always focus on total returns, and everything we show you today will be all about total returns. So the very first fund, MLPI from Neos. Now this one has been a fairly popular one. It's a fairly newer fund, but this one came out. This is all about the monthly income from the essential infrastructure of the energy industry. Now this fund here aims to provide high monthly income by combining North American energy infrastructure exposure and a writing call strategy. The fund is actively managed, which is huge, and MLP was launched in December 18th of 2025. So like I said, we're only maybe at best 6 months into this one. The yield so far is 5.76%. The growth is at 15.45% for a total return of 21.35. I show you the performance chart, which again is all based off of total returns. Since inception, we're looking at a 67.95% total return. Year to date, which is always going to be January to the current day, which is in May, of 21.35%. You take over the past 30 days or the past month, 6.38%. So you can just see this thing has a positive casting all the way across the board. Now, it's not a very old fund, so you don't know the long-term effects of what this is. But with Neos's image that they have of doing quality products and handling them and managing properly, with this one being managed, that's why you can see these things on the bigger percentages. So this is actually our number one fund. Number two, the Russell 2000 from Neos, IWMI. Now this one targets at monthly income from the small cap strength, which is the Russell 2000. The fund is, again, actively managed, which I just love. And we always call this one a fund that seeks to generate income by investing in the Russell 2000 index. while also employing a call option strategy. Now, IWMI was launched of June 25th of 2024. So realistically, we are only a few days away from its second birthday from Neos. So the yield, 13.65%. So very, very big yield. Growth, 4.97% year to date, for a total return of 10.12%. Now you're going to ask, why is it not up to the 17? Because the yield is giving you what a 12-month period is. Okay, while the growth, we can dial this thing into keeping it to year to date, and then we can take a look at a serious number. So we want to see how strong the yield actually is over a 12-month period, but we also want to see how the growth has been doing in 2026, and the total return gives us our answers. So we look at the performance of this fund. Since inception, 17.23% average. 1 year, 32.23%. Year to date, 10.12%. So that second year, when we finish out that second year, we're going to see some very, very serious numbers right back into, I'm looking more probably into that 17, 18% total. But what I also look at is the month side of it. 1 month, we're at 2.47. So that's showing us income and growth each and every month. As slow as it may be, it's still giving us income and growth every month. Year to date, we're at 10%. Divide that by 5. So again, you're right about that 1 month area, about a 2% per month growth. Next, QQQI. Now, this is probably one of the most popular ones out there, the Neos NASDAQ 100 Income ETF. We've talked about this one on the channel quite a bit. I talked to a lot of different people on our Patreon channel about this fund. This one, exposure to the NASDAQ 100, which is all your top, really your top technology right now, but it's your top innovators driving the future. Okay, gives you that monthly income. And this one I like is because they used a rules-based approach to their investment. Now, this fund seeks a high monthly income through the NASDAQ 100 stocks and call options, pursuing potential equity growth in a tax-efficient manner. And that's huge for QQQI. And we've done a breakdown of this. So if you want to know more about any one of these particular funds, pretty much all of these have been covered on the channel. But QQQI uses that 1256 contracts, which gives you a 60-40 incentive, which means 60% of the distributions are classified instantly at long-term capital gains. No matter how long you've held it or they've held it, it's always 60% capital gains, 40% short-term gains. But then they also flush in there with an ROC, which is return of capital, to help reduce that even more. So this one launched in January 30th of 2024. So we're easily working on our second year already. And average yield about 13.43%, growth about 4.73%. So they really put more into the growth, or into the yield side than they actually do in the growth side. But they have a total return of 9.78% year to date. 1 month, they're at 7.89%. So you can see it's really making a huge change in the past 30 days. But 1 year and since inception. So you remember, since inception, we're already over 2 years into this. So they're averaging 21.3% over a 2-year period. 1 year was at 28. So you could do the math right there to tell you that that 21 is about average across the board of what they're getting into. So this is why QQQI is such a very, very strong fund across the board. Next, SPYI. This is almost the same thing as QQI, except doing the S&P 500. One of the kings out there, one of the big leaders out there, you know, they're holding the Apple, the Microsoft, the Nvidia, Amazon, Google, and you're going to say, well, aren't those all the technology? Well, at the S&P 500 invests in America's top companies, and they earn that monthly income. So this is one of the long ones that we use in retirement. I personally use in retirement for generating income. So this one, again, the fund aims for tax efficiency, exactly how QQQI does with those 1256s, at 60/40 blend in the ROC, and high monthly income by actively investing in stocks and options on the S&P 500 index. The fund employs a call spread approach that uses the SPX index, which is the S&P 500 index, options, and future contracts. This thing launched in August 30th of 2022, so we have a lot of time under the belt of this fund, and it's done such a great job. Average yield 11.65%, growth 1.9, okay, for a total return of 6.09 so far this year. Over the past 30 days, you see a 4.26 percentage return on total return. Why is that? Well, S&P 500 did have a slow decline. And then once the war in Iran kicked in and we see the direction that we're heading and what's going on, that just turned around and said, boom, we're coming back. So it's kind of a little bit of a pothole, I'll call it, in the road. But you came back strong at 4.26, 6.09 over year to date. And now you take a look at these two, 14.87% since inception. Again, we're going to take a look at inception. This thing's almost ready to break that 5-year mark. It's 4 years already old. So for 4 years, your average is 14.87%. 1 year, 22.55%. So this thing is built for income, not for growth, but for income and generating a small portion for income, for growth onto it. So if you want me to break it down simply, you're basically looking at about 11% income and about 3% for growth. So as long as that growth number is above inflation, you're doing just fine, taking that 11% and spending it as to live on. That's why the SPYI is so big for retirees. Now we get into something a little bit different. This is going to be QQQH, okay? This one is designed, again, still high income ETF, but they're doing the H represents hedging, okay? They're hedging their bet on what's going on in the world. So this fund really, again, uses the large cap equities, and the fund is actively managed of stocks that include the NASDAQ 100 combined with option collars. The fund seeks to generate current income with some downside protection. That's what that hedging is about. This one launched in 2019, and there you can see this is where they originally started from, coming out with their NASDAQ 100, and they'll have one in the S&P 500, which are designed to give you that downward protection. Okay, if the market does slide, it's going to cap your upside. You're not going to get as much upside, but you're not going to get the downside drop off as much as before. Yield 8.85%, growth 2.48%, year to date 5.60%. Total return over the past month 5.17%. Year to date, as I said, 5.6. 1 year 18.91. So I have very, very strong past 12 months. Now we take a look at the 5-year, because this one has some history, 9.46%. Now that's always going to be an average. That's an average of 9.46% over 5 years since inception. And we can say its inception is just a little bit over that 5-year mark, 10.22%. So this is where, if you want a little more conservative, a little safer, but still getting some decent income, and we're looking at, I'm just going to call it an 8 and a 2, an 8% for yield, 2% for growth. That's probably just a hair under what the current inflationary numbers are. So you give you a balance between the two, but you don't have you do have that downside protection. You don't have as much worry about if the markets do start to crash. They do have some kind of protection out there. SPYH, same exact thing, other than we're using the S&P 500. Now these numbers are going to be a little bit stronger, but you got to remember, this fund, I'm going to tell it right off start with, April 2nd of 2025. So we just broke 1 year. And in this case, I say it's unfortunate. But in this past year, we have not had a bad year. Okay, we had a very, very good year in the S&P 500. So the numbers are going to sway a little bit. This is why I always say you got to look at things that have a little bit more history to it to really dial into it. And if you don't have the history, you got to dial into the 1 month, the year to date, and since inception. So again, this one's a tax efficient. When I say tax efficient, you understand that it's a 1256 contract. It's at 60-40 blend with a little bit of ROC mixed into it. High monthly income with some of that downside protection by actively investing in the stocks and the options of the S&P 500 index. The fund employs a put spread collar that uses the S&P 500 index option contracts. So, you're playing both sides of the fence. You're playing the put side, which is the downward trend. You're also playing the upside. Average around here, about 7.54% yield. The growth is 1.65, a little bit lighter to say in a retirement fund because you're not even getting close to the inflation current numbers. Total return of 4.33. Look the big picture. 3.37 over the last month. So again, got income and some growth. 4.3 year to date. So majority of that is going to be split. You're basically going to get into that about 1.5% of growth. The rest is income. 1 year, 18.57%, and since inception, 22.34. So these numbers, again, are very strong numbers in the S&P 500. So it really comes into is what are you looking for? Are you looking for security? Are you looking for income? Are you looking for growth? These are the areas where you start to figure out which fund actually works the best. And it's not saying you can't take two of them and put them together. But this is giving you the insight of where we're sitting. Now we get into a little bit different here. This is the NIHI, the Neos 100 High Income ETF. Now what's unique with this one is it targets 100 of the U.S. securities with the highest income potential. So we're not all just NASDAQ. We're not all S&P. We're just basically looking at it. We're going to target the 100 highest income stocks in the U.S. It seeks to attract that monthly income. It does have a rules-based and transparency in the process. And it's diversified across different sectors. So it's really built for that income-focused investor. Now, NIHI. This one here is really where we're starting to get into some unique pieces. The fund invests in ETFs and or stocks of any market capitalization from developing market countries, excluding North America. The fund aims to generate high monthly income from premiums earned from call options and dividends. Now, this fund launched in September 17th of 2025. It's not been a full year yet. And because of the geopolitical stuff going on, everything happening out there, I don't think the performance is done as well as other funds in their marketplace. Just me personally speaking. 7.10% yield is what they're looking at over a 12-month period. When we look at that since inception, so we're really not even a year old yet, at that 7%, that means you're really getting about a 6% total growth. Well, so far, the fund has had a negative 0.04%, which is very minute, but it's still a negative. And that gives us that 3.65% total yield of year to date. 1 month down 0.31. So this fund is really kind of stuck. It's stuck in the mud. It's stuck in the mud trying to figure out how to get out of this because it's only using those developing markets and what's happening. Oil affects a lot of different countries. So oil's playing a game with the Straits and the war in Iran. All that plays a game into these type of funds. So at 3.65, it's not one of my favorites. It's not one of my particular pieces of Neos that I'm really invested in any way, shape, or form. It just doesn't do what I need it to do for my personal portfolio. And the performance so far has not been the greatest. Now we get into IYRI. This is, again, built, they always say this, built for income-focused investors looking for that monthly income and enhanced yields. Again, I always have to question this one right off the bat. If it's enhanced yields, are you looking at total returns or are you just looking at income? And that's why I always say you got to look at the total returns. We're not going to be chasing yield. Okay. This fund here is actively managed and seeks high monthly income with the potential appreciation by actively investing in stocks in the Dow Jones U.S. Real Estate Capped Index. So many people look at this when they think they're investing in actual real estate, but we got to say you're really getting into the real estate capped index. You're buying an index which is built around real estate. This one came in January 14th of 2025, so we're just a hair over 1 year old. The yield that they post about 11.33%, so it does give you that high income, but you got to ultimately look at your growth. So far, year to date is down 0.31%. So if you did get the full 11%, take away that 0.31, it basically is a flat out 11% return, zero growth. Year to date, 3.38% total return. We look at the 1 month, it's down 1.20%. So this is not something that's consistent. It's got a lot of volatility built into it. 1 year was only at 9.20%. So they're saying they're targeting 11%, but realistically, total return after 1 year was only 9%. So it's not as strong as a fund that people look at, other than being diversified in their portfolio. You look at the inception of 7.92%. Again, this is not as strong of a Neos product as we see of the S&P 500, the NASDAQ 100, and even the Russell. So this thing here, it's kind of tough. A lot of people, I can go back and say, think they're going into the real estate market with it when they're actually only buying the real estate index, and that's only one segment of many different segments that are out there. Now we go on the gold miners, IAUI. Gold miners has been on such a run with gold pricing rocketing up. The gold miners is the guys who are trying to get it out of the ground. So you're not really dealing with gold itself. You're actually getting the guys who are digging for the gold. Gas prices can play an effect in this, cost, and then trying to find the gold, and a lot of times can be the real issue. So the fun is, again, I love this about Neos. I just got to say this out again. I love this about Neos, that majority of their funds are actively managed. Okay, you go out and think about this. You go out and buy a financial advisor and pay them 0.5% to 1.5%, of what your funds are, and you're getting them here included into it for a very minimal expense ratio, which all these prices, of course, always show full expense ratios. So that's a huge factor to it. This one seeks monthly income by investing in gold ETPs, combined with synthetic options and covered call strategies. Now, this one launched in June 5th of 2025. So we're just, honestly, just 3 weeks away from the 1 year celebration of this one. Since inception of 25.52%, okay, they're shooting for a yield around 11% again. The growth is down 0.89%. Total return of 3.23%. Now, the past 30 days, it's down 5.05%. I said this at the beginning. The biggest issue that these guys are running into, fuel cost, diesel costs. Because this is not like running down to your Shell station or your Amoco or whoever, where you're buying your gas from. At $5 a gallon for diesel. These guys are out in a remote area, so they have to have it actually trucked in on their own. So there's additional fees on top of that. So it's really cost them hard and it's hurt their bottom line. That's why you're seeing the big drop off in that 1 month is fuel costs. So this one here, is done good, but it's also a fund that I personally made a suggestion to a couple of our Patreon supporters, and talking about Patreon, not an ad in the middle of this, but if you can go in the description, you'll see where it says Patreon. You can join our Patreon, get it for free, ask questions all you want over there, and then you can also support the channel if you feel that we're willing to, willing to accept any type of support. But we told them, and here's, it's time to get out. It's time to move to something else, because this market has, until fuel prices readjust and get things back on track, these things are you're going to see a lot of negative downward trend. That 25%, you're probably going to be pouring it back in if you don't capture the gains right now. Now we're going to get into CSHI, which is Neos' Enhanced Income 1 to 3 month T-bill ETFs. Now I know this is not going to get a lot of people excited. This is not going to be one of the top ETFs people talk about, but it is one of those situations that you put holding money, you put retirement money into, and the T-bills, kind of one of the situations that the durations is at 1 to 3. It's designed to get you maybe a little bit more income than just putting in a savings account in a bank or even just holding money. But these short-term durations in the U.S. Treasury bills actually are lower for rate sensitivity and are easily daily liquidity availability. So the fund is actively managed. Even in their T-bill section, they get actively managed. It invests in the portfolio of U.S. short-term Treasury bills while utilizing a combined with the large U.S. cap put spreads for the future. So if the market's going down, these things are looking to have, again, income from a declining market. So the numbers here, really, I'm going to tell you, you're looking at about a 4.92% yield, okay? A growth of 0.02. So your growth is not big, but this is like think of a savings account with T-bills. You're just trying to collect yearly income. This fund is August 30th of 2022. So again, we're shy of that 4-year mark, but you're looking at 5.549% since inception. So a little over 3.5 years, you're averaging about 5.49% per year. Higher than a savings account, isn't it? 5.30 in the last 30 days, so very, 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 in the last 12 months. So very equal to what I just said. Everything, the numbers all mathematically work out. 2.02% year to date. It's going to get us to our 5%, and you're seeing a 0.42 over 30 days. So across the board, this is the safety net where you're putting money into as a safety barrier of money that you may have sitting on the sidelines waiting to invest in the future pieces, or long-term investments with a short-term operation with those T-bills. Same thing, HYBI was going to be the bond side of it. And this one, the fund, continuously sounds like a parrot now, is an actively managed fund investing in U.S. bonds via ETFs and using S&P 500 put options. So they're doing it in a very tax efficient way, and it seeks a balanced investment in high yield and investment grade securities. So this one's going to be maybe a little bit longer term investment. This one came out September 30th of 2024. So again, we're just a little over a year, I'll say a year and a half old into this one. Since inception, 4.47% total return. 1 year, 7.48. 0.88 year to date. Okay, so it has struggled lately because we see this thing at a negative 0.45 in the past 30 days. So an 8% overall yield is what they're shooting for, with a growth in about 2.48% realm to try to get you into that, again, that 4 to 7%, 4% average, 7% over the past year. And I really look at the breakdown of this one. I can see where they're trying to achieve that 7% total return. But it's really getting into where you're investing money into long-term U.S. bonds and using the put options as some security. And our final one, BNDI, again, This fund is actively managed and invests in diversified portfolio of fixed income securities with a varying maturities and credit ratings, while utilizing large cap put option strategy. This one came out August 30th of 2022. And it's all around. These are things where you're looking at where you're aggressively bond funds and so on, where the market, you don't know where your direction of your market's heading, but you want some security in certain areas. This is where the bond fund comes into. Since inception, not big numbers, 3.73%. 1 year, it had a fairly decent year at 7.18% over the period of time. 0.47 year to date, so it's really struggled, I'll call it in the mud right now. Down 1.16. So it's a good fund for long term. It's not going to be an income generator. It's not going to be a growth indicator, but it's better than putting your money just sitting in cash, sitting there doing nothing. For the simple fact is it does have some return of yield. So in summary of the funds, you can see MLPI is the number one, which is the Energy Infrastructure High Income ETF. So this one's playing with not just the oil. They're not into the oil side. They're into the pipelines that's pumping that oil. They're getting the gas where it needs to be. They're doing all of that with the very efficient way and give you some good strong total returns at 21.35 in just first 5 months of the year. So you're getting some good growth with decent yield. So there's a big difference between the two. So the growth is making up for a good section of it, but it's not as big of an income as most people may be looking for. So if you're looking for a growth, great piece to be there. The income generators, the Russell 2000, the NASDAQ 100, and the S&P 500 are all very strong with very respectable total returns. Then we get into the other ones, the hedges. Again, you can build a complete portfolio almost literally just from Neos. And that's why I wanted to do this, to give everyone the idea who's the best and who's the worst across the board of a Neos funds. Let me know your comments below. I'd love to hear from you. Tell me what you think. Do you hold all of these? Do you hold some of these? Leave a comment down below. I'd love to hear from you and get your feeling. Also, how do you like the presentation that we give you? If you like it, hit that like button, and we'll keep doing it for you. We're going to try to break down each and every one of these as we go along throughout the year. Just keep you updated on each and every one of the funds, and we appreciate your time.
Thank you for watching. Press the